Hello and welcome to our webinar, Getting Long-Term Care Planning Right. We welcome you, and as we wait for everybody to join in, we have a poll that you can test your knowledge. So I will launch the poll. Please feel free to participate, and we will get started here shortly. So welcome. Hello and welcome to Getting Long-Term Care Right Planning. Long-term care planning right. We have a little quiz here while we wait for everybody to join us. So please feel free to participate, test your knowledge, and we will get started here shortly. Hello and welcome. Welcome to the long-term care planning webinar. Apologize. We have a poll running right now. You can test your knowledge while everybody gets logged in and settled in, and then we will begin. All right, well, I think it might be time to look at the poll results. So at this time, I will run through the results and the answers, and then we'll get started with the webinar. The percent of Americans over 65 who will need long-term care, 70% of you, 67% of you said 70%. And the answer to that question, Brian, do you want to divulge or shall I?
No, that is the right answer, Tony, 70%.
Wonderful, we have a knowledgeable crew here. Question number 2, what percent of Americans who think it is very likely they will need long-term care at some point in their lives? 54 said 70%, 46 said 8%. And the answer is?
Yeah, Tony, that is 8% is what people really think they're going to need it. So.
And the final poll question, what percent of Americans who have long-term care insurance? 67% said 3%, 33% said 8%.
Well, we have a very smart group, Tony. Yep, 3% is the right answer. 3% of the population has long-term care at this time.
Wonderful. So I've shared the poll results. I will say hello and welcome to everybody joining us for Getting Long-Term Care Planning Right. It's a tongue twister for me today for some reason. We have Brian Bohnsack with us today to guide us through the presentation. We will field questions as we go through, and you can wait till the end. We do have a Q&A session planned as well. So welcome to our webinar, Smart Approaches for People at All Stages. The problem when it comes to planning a safe and secure retirement, long-term care remains a confusing and unaddressed challenge to many people's financial security. The solution, in order to feel safe and secure about your retirement plan, you need a custom approach, a real plan for how you'll pay for long-term care. So Brian and Mike will cover what long-term care really is, how relying on Medicare and Medicaid is not a plan, historic problems with long-term care insurance, and new approaches to planning for long-term care for people at all stages of financial planning and health. With that, I will hand it over to Mike to introduce Brian.
Well, thanks, Johnny. Hello, everybody. Thanks for joining us on this webinar. It's an important topic. And it's an important topic because frequently a lot of people don't want to talk about it. And when they don't want to talk about it, they think it's an issue that kind of goes away. But when we look at wealth management and the different components of how we manage our clients' wealth and whether we're good stewards to that process, we have to look at investment options. We have to look at retirement projections. We have to look at estate plans. And we have to consider taxation within all the moves that we make. And one of the areas that they really want to help our clients address a little bit more is how do we manage risk? And it doesn't necessarily mean risk in a portfolio. That's, again, a different conversation than today, but it's the risk within our lives, whether that's long-term care needs and the risk that is evolved around that, or if it's something along the lines of risk regarding life insurance or estate planning and the taxation that goes along with it. The nice thing about today's program is Brian has put together, and he has a lot of expertise in this area, a nice logical way to look at how long-term care should at least be discussed. And then with your advisor, you can decide if it makes sense to go down an insurance route, to go down a self-funding route. And again, Brian can talk about, and we'll talk about the pros and the cons of that. So Brian has joined us as part of our activities of expanding the 360 Financial flag. He is the managing partner up there in the Elk River location and brings a wealth of knowledge in the risk management area. So we're really glad to have him on the team. So Brian, thanks for putting on this presentation today. I know it's going to be great for our clients, and it's going to be great for the people that aren't clients yet with 360 Financial to learn a lot about this topic. So thank you, and I'll let you take it away.
All right. Well, thanks, Mike. Appreciate it. Thanks for kicking it off. I think you hit some of the really good high points. Let me go ahead and share my screen and we'll get started on the presentation part. Like Tony said, please go ahead and give us any Q&A down in the Q&A section. As they come up, we'll try to address as many as we can if we have time. If not, we'll always follow up with you after that. So let me go ahead and share my screen. So yeah, like Tony was saying, we're trying to get this message out, and it's something that's been always on our topics as we've been meeting with clients about how do we deal with long-term care. And as the polls were saying, there's a big, misunderstanding on how much, people do have coverage already, how much you're going to be able to use it. So this is, again, our goal. In our practice, we talk about a lot of different topics, Social Security, and like Mike was saying, retirement planning and tax planning and, IRAs. But we always come back, or we always try to always address this risk that we have potentially as we get older and regarding long-term care. So this presentation kind of goes through 4 different keys. We're going to, talk about some myths. We're going to talk about some facts. We're trying to maybe debunk some of the myths, and then just highlight some of the facts that may or not out there in the public or not in top of mind. Because, something that Mike and I and the other advisors at 360, we do this every day. Obviously, the people that are attending this webinar, it's not probably top of mind, but maybe have some firsthand experience, and some of that information might be a little bit outdated. So we're just trying to bring that up to date here at this webinar. So again, there is a problem about, how do we have a safe, secure retirement and still understand our risk around long-term care? It's very confusing. It's unaddressed, which we kind of talked about in the poll. And sometimes it's not really out there with people's plans. So that is definitely the problem. But we believe at 360, we have some solutions and some education and some information that we can definitely share. So maybe the question is, why aren't we taking this issue more seriously? Well, there's lots of good reasons, and this PowerPoint has quite a few different bullet points, as you can see on the screen. Some of maybe it's too far off. If you're thinking you're young and, only long-term care happens to older folks, or you have this false sense of security that, hey, I'll just take care of myself. Or you think there's a medical or a government program that will pick up if I have somebody to pay for my services out of a long-term care facility. We're going to talk a lot about Medicare and medical assistance around that, or Medicaid. Again, maybe people think it's never going to happen to me, or I have this great family that will take care of me, or it's just too darn expensive and I just don't have the resources even to think about a plan. So those are some of the things why we have maybe underplanned in long-term care in that area. And it's not just you and your spouse or significant other. There's also your family, children, other family members that are going to have to maybe deal with a long-term care crisis that might happen to you or your spouse. So it now becomes multiple generation, and obviously you can read on the screen, it's both emotionally, could be challenging for those next generation, or it also can be financially. They miss work. They have to take time to go ahead and take care of mom and dad or something that's going on in that life. So we want to address that as well. It's just not the parents or the individual, it's the next generation.
And Brian, before you jump off that one,
Yeah.
just one thing I see, with the sandwich generation, we see it a lot with our clients. I've been doing this now about 30 years. So I've had clients that retired with us. I've had clients that, have unfortunately passed away and kind of anywhere else in that cycle. And the sandwich generation, a lot of times does get in a bind,
Yeah.
and frequently my experience is it's one of the daughters that are kind of responsible for this, not all the time, but
Yeah.
frequently it is. And they also are the ones that are maybe juggling their own career, juggling what needs to the kids have at home and to get the soccer games and the practices and they've got to run off to help mom or dad or both. It's a very stressful time
Yes.
for that adult child. And I think a lot of times we know as older people, I guess I'm in that category. I don't want to ever move in with my kids. That's something I'm not interested in. I don't think any of my clients really are either. But at the same time, you need some help, and I really think that emotional aspect is something that weighs on people outside of the family. You probably have seen the same thing.
Yeah, many conversations with those clients that are, in their 50s and they have a parent that's in their 70s or 80s, and then they still have kids in high school or college. And talk about, and you're right, it's typically maybe the female, the daughter, the wife that ends up trying to juggle that too, just because they're typically the caregivers, aren't they, Mike? So,
Yeah.
So,
I just wanted to bring that up. But
thank you.
Yep.
So I think going to the next slide here, coming out of COVID, we saw a lot of people says, I just don't want to ever be in a nursing home. But, I think that's maybe that old thinking again, Mike, that, care can be given at so many different places. First of all, people want to stay in their home. So that is becoming more popular, trying to figure out how to stay in my home and get the care and the services I need. Or as you drive around the town, there's lots of new facilities moving up that are senior housing that's independent living, and there's senior housing that has, care. You can add, nursing or other assistance, do that. And that's that community based. I think, you would probably be very happy to see a parent move into one of those facilities that have a social network besides the healthcare also support too. So I think we're going to talk a lot about that today.
Yeah, you're
again,
right about that. I mean, just from the standpoint of loneliness is a trigger for all kinds of issues for people who are getting up there, and any way that you combat that is really, really helpful. I think it makes people healthier, so they're probably less likely to need some of these care treatments if they can keep that loneliness at bay.
Absolutely, yeah. So it's more than just health. It's also personal, and social needs that we have, especially coming out of COVID. We've all seen how the isolation has really impacted our elderly, community. So I think this slide's great to talk about because again, people don't really truly understand, what triggers long-term care, what is long-term care, and it's not, it's taking care of yourself in a healthy way, keeping you safe and be able to live independently. It's, so be able to bathe on your own, dress and eat and get out of bed, obviously using the bathroom is all those things. And then of course the dementia and the Alzheimer's also is part of that ADL. So lots of companies, when you do buy insurance, they'll talk about ADLs or the activities of daily living. And when you hear that term ADL, this is the list that they're talking about. And it's about having, again, that independence, are you independently able to live on your own or you're not independently? I was sharing a story earlier about this is not going to take care of your housekeeping or your cooking. It's truly be independent, safety and keeping you healthy. So not necessarily having somebody in to cook your meals or clean the windows. So those are the ADLs. This is part of our poll. So we talked about this earlier about there is, if you polled America, they would say, hey, I think I'm only going to need long-term care 8% of the chance. Only 8% of the population says, yes, I think I'll need some long-term care in my future. The reality, the statistic is 70%. Maybe that's an alarming number. That might be high. And, sometimes we can use statistics, that kind of maybe think that. But I think some type of long-term care. It may be for, a week or might be for 3 months. But the statistic underneath that, 70%, there is a very high percentage, 10 to 15%, that will need long-term care for an extended amount of time. And they're saying 3 years. So we know somewhere between 70% to 20%, it's going to be 1 year, 2 years, and 3 years of help. And how much does that add up to? And we're going to get to a slide of how much that would cost to have that care. So that's a, kind of alarming disconnect that we have going on right now between what people think they're going to need or use and what is really people are using for long-term care.
And that longer term care, as you point out, and you're going to point out later in the presentation too, God forbid you get, diagnosed with Alzheimer's or dementia of some sort, and your body is healthy and unfortunately your mind isn't. And those tend to be really long-term care needs. And I'm sure you've seen that as well over the years.
Yeah. And that number, when I got into this business, it was not 70%, it was more 50%. When I was sitting down with a couple, they both turned age 65. I always said, hey, there's a flip of a coin that one of you are going to be using long-term care need sometime in your future before you pass away. Well, now we've seen this number go to 70%. And a lot of that is being driven by Alzheimer's and dementia. And it's also being driven by our great United States healthcare system. We have better, better medicines and better surgeries and better medical treatments. And we are keeping people alive, but maybe not, unfortunately, healthy enough to be independent. So that's the other reason why long-term care needs are growing over the last 20, 30 years.
Mm-hmm.
Yep.
Makes sense.
Yeah. So, and I think people think about nursing or long-term care, they always jump right to nursing home. And I mentioned this earlier, really it's becoming more, assisted living, independent living, and at-home care. And that's where the growth and the focus on is, how do you stay at home? How do you not be into that traditional nursing home? So that's kind of where we have a lot of different healthcare settings. So when we're doing financial planning on the left-hand side of the screen, we're always focusing on your medical costs. As soon as you leave your work and you go on to Medicare, there is a large dollar amount that we have to set aside for financial planning purposes to pay for your healthcare costs. But it has nothing to do with long-term care. This is just, medical and dental and vision and prescriptions. So a family or a couple that's retiring, they may spend $300,000 out of their retirement just for that part of their medical expenses. And on the right-hand side, now we're jumping to what if you do need long-term care facilities. And these are updated numbers for Minnesota. The average, maybe the assisted living is that smaller number, that 49,000. And that bigger number might be more of a traditional nursing home. Unfortunately, maybe it's more memory care where they're, more hands-on care that can run into the hundreds to $120,000 range for here. And of course, in the state of Minnesota, it could be, higher costs in the Twin Cities, maybe a little bit cheaper in the outstate. But those are some startling big numbers to get your head around. So key number 2 is, again, we think Medicare or there's some social government program that's my plan. Well, that's not a really good plan to rely on for long-term care. And I'll tell you why, because a lot of times you're not eligible to go on to Medicare or Medicaid until you meet certain needs. And we'll talk a little bit about that. Starting with Medicare. So Medicare does not pay for long-term care costs. Now you're thinking, well, I had this situation. I heard somebody go from a hospital into maybe a rehab hospital because they had a knee or a hip replacement. Yeah, technically they maybe went into a skilled nursing center and it looked like a nursing home. And Medicare did pick up that for the first 90 days or up to 90 days. But again, that wasn't the independent living situation. That wasn't because you need custodial care. It was really more for getting you out of the hospital quicker and into a facility where you can get better and get back home. So that's when Medicare kicks in for some short-term, rehab or skilled nursing care. And then you're saying, well, then there's Medicaid, or in Minnesota, we call that medical assistance. That's a plan. I'll use that when I do that. Well, there's some myths around that, or some misconceptions or surprises that may come up. First of all, you have to use up a lot of your assets. In the state of Minnesota, we have this spend down requirement before you can apply for medical assistance. And you have to, get your income down, or have to use most of your income to pay for your own services. And before you can apply for Medicaid, some of these thresholds have to be met. And we have a lot of discussions around that, Mike. Maybe you have a story or two to share in this conversation you've had with families thinking about how to get their Medicare, maybe gifting strategies.
Well, there's a couple of things. I know you're going to talk about the look back period,
Yeah.
but one of the concerns that I hear a lot from people is if I need care, so let's say in my situation, I'm 58 years old. My wife Ann's 10 years younger than me. Let's fast forward 30 years and I need care. And hopefully I've done my planning. Either I'm self-funding it or I've bought some sort of policy that will help cover the cost. But let's say I didn't, and this is the concern I hear is my wife going to get kicked out of our house to pay for the care? And that's a big worry that I'm not going to be able to provide for my spouse because I'm eating up all of the assets of our estate. And I think that would be something, Brian, that would be really helpful for the audience for you to address.
Yeah, under current numbers that are out on the state of Minnesota. So let's say in Mike's situation, so Mike is in this facility, he's married, all his assets are joint with his spouse. Yes, the healthy spouse or the spouse that's not applying for medical assistance can keep under today's numbers right around 148,000, and the home and a car and some funeral policy. So there's some assets that can be disallowed. You don't have to spend those assets down, but a majority of Mike's and spouse's assets would have to be spent down to that lower number of 148 before you can go in to apply for medical assistance or Medicaid. So and the home is one of those exempt assets, so along with the one car. So
the 148,000 is not very much to leave, for somebody to live on,
especially
if there's a discrepancy in age with the two,
Absolutely.
So it's a concern for me, but it's a concern for a lot of people out there, I think.
Absolutely. Then let's talk about this look back period. So I have this conversation with, I'll just gift all my money before I need to go on to, before I go into the nursing home or the assisted living, I'll gift it to my children. Well, Minnesota will look back and see if any assets were on your balance sheet or in your possession and now they're no longer there. What happened to them? If you were selling things at a loss or a below market fair market value, or you're doing outright gifts to the next generation, family, children, they're going to say you're not qualified because you gave away those dollars, and they're just going to push out your application that equals the amount that you gave away during that 5-year time frame. So that's again, not a plan. You can't plan around trying to gift your way out of the medical assistance strategy.
How about before you jump off that one, one thing on the gifting side I hear sometimes is, I'll just put my kids on the deed, the term that's, so put your kids on the property, then you don't have to worry about that. There's all kinds of issues with that, but that also goes into the 5-year look back, doesn't it?
Yeah, it goes back to the 5-year look back. If it's one of those disqualified assets, meaning like a house that, they can keep. But if you go on medical assistance, let's say the county pays for 3 years of coverage, you fortunately pass away. Well, if the family still owned the house that you left and your name was still on it when you passed away, they will end up trying to use that asset to pay back the county or pay back the state for that. So when your children start selling your real estate that was excluded, they may have a lien on that property that equal to the amount that the county or the state paid for your care for those years. So
Thanks.
So in your case, your spouse didn't get kicked out of the house, but if you were getting assistance from the county or the state, that will be the amount that they may apply to that house that your spouse was living in, or the house that was sitting empty before after you pass away.
Yeah, and sometimes I see that people, like I said, they'll just say, well, I'll put the kids on the house, or, and part of the problem I point out, and this has nothing to do with long-term care insurance. It actually has to do more with kind of estate planning is there's all kinds of issues there. You might not get a step-up basis in the house. You also, if the kids get into any sort of legal issue, that's now an asset of the kids, and therefore somebody could go after that asset. So there's a number of reasons you really don't want to solve some of these problems by changing the deed,
changing the deed or getting through that look back period. Absolutely. So this one is also, and this one's probably not very common, but I have a good story here. But this is saying, hey, you have, facility right in your backyard. Like I'm here in Elk River, there's some really great facilities here in Elk River and Rogers. You're trying to get mom into the facility here. You are on medical assistance, you're on Medicaid, and you walk into the facility of your choice and they're saying, well, we don't have any room because you're on medical assistance or Medicaid. Your closest, room is up in St. Cloud or Fergus Falls. Well, not very convenient for family and friends to visit when you're 30, 60, 90 miles away. So again, because you're on medical assistance or Medicaid, you're not in control of what facility you may walk into. And the other story that I like to share is, you may pick your facility and you're going to self-pay for 2 years because you do have enough assets or you had enough insurance to pay for 2 or 3 years. Then you run out of, assets, and then you apply for medical assistance. Well, now that facility may come knock at your door and say, you are no longer welcome here because you're not a private pay customer. You're not in control of your, of your situation. We're going to have you, exit this facility and you're going to have to find a new facility. So those are real life stories that, can really disrupt the care and the comfort of a loved one. So those are, again, some surprises about that. So the next thing is like, I've heard long-term care insurance, maybe that's what you're thinking, that we're trying to, direct this conversation. And really is not the case. It's really just having a plan. But of course, insurance is one way to can deal with that, and there's, like the question here, is there really any good options? Well, let's kind of talk a little bit about what are the options in the insurance where, but let's, first of all, we've maybe heard some stories. Long-term care insurance in the past, it's been around for a long time, is very confusing. It didn't work. People, didn't get the coverage they thought they signed up for. Like I said, it's been around a while. Yes, it's had some issues. And that's one thing, long-term care, we'll see in a couple slides, it's really changed. So some people have misconceptions or old information about the original long-term care insurance that were sold back in the 80s, became very popular in the 90s and the early 2000s. Lots of insurance companies were in the market. And then fast forward to today, now we're hearing clients that have bought policies, they're seeing the premiums jump up. Again, maybe refusing to pay claims, maybe policies are getting canceled. So lots of noise out there, and I've been spending a lot of time with clients helping them navigate this, but that is some of the challenges. But it should not be a hindrance to having a plan. So yes, there's some new noise in the background or in the past, but going forward, there has been really, some really good new strategies coming up in the insurance world.
So Brian, before you jump into those, I mean, I've had real life case last week. I had a conversation with a client that, has experienced exactly what you're talking about. CNA policy, CNA came back and they said, hey, we're going to bump up your rates or you can take this cash payout. And it's interesting enough. One of our participants here on the webinar in the audience sent a message that says, I've been paying for long-term care for 10 years, just received a letter from the company notifying us of a significant increase in premiums. Then she goes on, that they could have a lump sum type of, payout. And, she just says, what would you advise? Yeah, I'm 70 years old. I mean, that's exactly the sort of case. If she bought it 10 years ago, kind of an older policy, I would strongly encourage this person to reach out to you to talk about the different options, because these letters are showing up more frequently from what I'm seeing. Yeah, and you probably are too.
Yeah, we have a lot of policies in place that were in my firm for many, many years. And now they're seeing these, and it becomes a really good conversation. And the clients really, appreciate that we can sit down with a client and talk about the pros and cons, because they can be customized. And people's situations have changed. Maybe if you were married, now you're a widow, or you found that, hey, maybe there is another plan that you are going to do. Maybe it is a multi-generational family home that you're, thinking about. I know, Mike, you're not going to move in with your kids, but maybe there's some people that have a family member that say, hey, mom's never going to go to the nursing home. She's coming here. We're going to build a wing on the house, or second thing. So yeah, and those are changes. So maybe a buyout is the right option, or maybe taking some of the riders off it to get the premiums down. So
Let me just state real clear. I love all my kids, so it's not a matter of anything along those lines. If they build a wing on their house, maybe I'll move into the wing.
I know, exactly.
But so
Yeah.
these letters that are showing up, and they've been going on for a little while now. It's a reflection of these insurance companies really just didn't calculate their risk properly, and I guess you could blame them, can't blame them. Matter, they just didn't know what they. And I remember a long time ago, they were kind of basing it off the same tables that they would use to value life insurance, and it's actually the complete opposite of that. And so they have to go back to the state of Minnesota and ask for the ability, the approval to raise them. And that's when these letters show up, and they can't go to you, Brian, and say, okay, we're going to raise yours, but not raise mine. They have to go to the whole class of people that bought that long-term care insurance type or policy, right?
Yeah. Maybe I can spend a couple seconds on why the insurance carriers got themselves like into this. First of all, they didn't price them correctly when they sold the policy 10, 20 years ago, because they had models, assumptions that they thought people would use the policies in a certain percentage. Well, that usage is a lot higher than they ever thought. The second challenge they've had, and we've all witnessed this, is low interest rates. So when they built those models, interest rates, 5-year, 10-year treasuries were at 5 or 6%. Well, now for the last 10 years, we've had treasuries, until recently, in the 1 to 2% range. Well, their cash reserves, the insurance companies are sitting on this cash waiting to pay out benefits someday in the future, and they weren't making any money on that, and now they're behind. So now they have to pass on those lack of interest rates and the higher usage with higher premiums to make the books work. So, and the other thing that's happened too is all the carriers have jumped out of the policy. Now they're still supporting their policies that they have on the books, but we have a town, a hometown insurance company called Allianz right down in the Twin Cities, and they're just not even in the long-term care insurance market anymore. And they were one of the biggest players back in the 90s and early 2000s. So.
Yeah. And there was one question I just want to address as we're going through this a little bit, that somebody says, I don't understand your comment that the past challenges of long-term care insurance should hinder us in considering long-term care insurance. These are real issues and challenges. Please explain your reason. And I don't want to speak for you, but I think the point maybe was, sometimes people are reluctant to plan around this because they've heard stories about how these policies haven't worked in the past.
Yep. And that's a great segue right here. So planning for long-term care is futile. It's not going to be effective. And I think my point was that what happened in the past, there's all these new options, more flexible, more, meet some of those pushbacks that we get from clients and people that want to buy long-term care, that the new products that are on the street today are so much different, just like your cell phones, just like your PCs. It's time to come into the future and say, hey, let's address those issues that we had in the past. And the insurance company's done a really good job of that, and take care of some of those roadblocks or those pushbacks that we get. And we'll talk a little bit about that. But that's why I'm just saying, I think some people throw up their hands and say, I'm not going to deal with long-term care because of the issues that we heard from the previous generation or the old policies. And I guess that was what I was trying to address with the person that answered that or put that question in. So, because there is a lot of new approaches. So there is new improved long-term care insurance, the traditional insurance where you pay a premium, and if you go on claim, they'll reimburse you. The other two new, more recent ways to buy long-term care insurance is to buy it in a life insurance chassis or a life insurance policy with a long-term care or chronic illness, what we call rider or benefit, or an annuity. So these again are both insurance products provided by life insurance companies here in the United States, using the life insurance as more of the chassis versus the traditional insurance where it's more premium based, or very similar to like your fire or homeowners insurance. You pay a premium. If you never have a claim, there is no return of the premiums when you sell your house. But with the life insurance side, obviously there's lots of features and benefits beyond the long-term care, and we can talk about that in the next slide. But those are things why I think the future of long-term care planning is so much different than the past. So I kind of mentioned this already, the long-term care, they've improved them, still have some, features that may not be perfect fit for everybody, but for some people, this might be the right fit for somebody that's thinking about creating a long-term care plan to still go into that traditional long-term care insurance. But I'll call it 2.0. It's a new improved. Where I think most of the focus has been recently at trying to solve the long-term care problem is with life insurance or annuities with these long-term care benefits or riders. So you're putting money into a policy, it has a death benefit, but if you go on claim, again, same of those things that we talked about earlier, the 2 out of the 6 ADLs, the activity of daily living, now you're accessing your death benefit while you're alive. Well, that sounds pretty great when I can, hey, I'm going to need, those expenses covered while I'm alive. And I just take it out of my death benefit that was going to go to my family or to my spouse. I just get to access it while I'm alive, what I kind of call the Swiss Army knife of a long-term care policy, along with all the other benefits of life insurance with the death benefit, cash value potentially. And you can do the same thing on the annuity side, it has some different features than the life insurance. So those are the products that I really think are coming to front. Those are the products that most people are thinking about if they're going to put a plan together and put some insurance in their plan. This is where they're putting their resources or their attention to.
So I'm going to jump in here with a question I thought was interesting. I think it fits right into what you just talked about. It's for one of our viewers, and again, it says, I agree that possibly 70% will need long-term care, but it seems like unless it's outside of Alzheimer's, the care needs on average is about 1 to 2 years. I think your stats might be a little bit longer, but let's just say that's right. Realistically, how does she put this? Realistically, you only need to plan for expenses for long-term care for 1 to 2 years maximum. What are your thoughts about this 1 to 2 year time horizon?
Yeah, if we're thinking about a range, I think 1 to 2, maybe on the shorter. I think what I've been reading a lot is 4 years is the average. And then of course, there's always these outliers. We always talk about the long-term care with the Alzheimer's, the long-term care with dementia, things like that. So yeah, I think 1 to 2 definitely is, maybe on the low end. I'd say, if somebody came in and say, hey, we're going to build a plan that's going to pay for most of my care I could expect over a 4-year time frame, I think you're covering a large percentage of the population that's going to go on some type of long-term care. So,
and it always comes down to how much risk you want to cover, right?
Yep.
Either through your planning and paying out of your own assets, or through a funding vehicle like an annuity that has long-term care benefits to it, or a life insurance policy that has those benefits. So you can always self-insure or self-fund part of that risk, and you can spread out some of the risk by having an insurance company do it. So there's we don't know what the answer is, right? We have a particular person might need 5 years of care or might need 5 minutes of care. It's just a matter of how do we plan around the what ifs on that.
Yes, and having that plan, written out and understanding, and then having the family member understand what is your plan. So yes, if it's going to fund, for 1 to 2 years, and then you're going to self-fund, yourself out of your own assets for the remaining. Lots of families are doing that because some planning and some, types of reimbursement will really take care of, putting a lot less pressure. And that's probably a good segue to, talking about the self-funding options and stuff, and sharing that risk between an insurance carrier and your own balance sheet. So,
because that comes into a question that's, I'm just trying to get these in here as they come up. I know Trony was going to do it, but I'm kind of taking her thunder. So in what situation, and it just goes right on to the end of your last sentence there, Brian, in what situation would you consider self-insuring, we call it self-funding, for long-term care versus taking out a long-term care insurance policy? And I think the answer there is have the conversation, plan around it, see where the shortfall is, if there is one, and see what risk you're comfortable with, and you can work with your advisor to determine what's the better strategy for you.
Absolutely, yeah. I mean, obviously, most clients are getting Social Security checks, so maybe obviously if one spouse goes into a assisted living or a chronic, long-term care facility, and you say, hey, that person can take their, Social Security check, and then if you get an insurance check for long-term care on top of that spouse's and, Social Security, and that covers most care that you would ever think you would ever need in the future, that leaves the other Social Security check and all the other retirement assets that you've saved and dreamed for left, for the spouse that is not on care. I think that's a really good strategy as well. So you can take on some of that risk because you can pay for some of your care out of your Social Security or a pension check, and then leave the other assets that are in retirement accounts, alone. So you're not doing that, which is, I think that's what that person was trying to
I think so.
question.
Yeah, I mean, it has to be a customized approach to it. Your pension is a great example. Sometimes people come to us if they have a pension,
Yeah.
which we know most people don't anymore, but they come to us and they still have one. They might have made the decision on how to take payouts of that pension a number of years ago, and those are irrevocable. So if they're like, well, let's get the maximum amount that I possibly can, which is a single life payout option. That might affect your decision a lot more than if you had taken some sort of joint life option or even a period certain option. So
Absolutely.
it really comes down to a good, almost mathematical conversation about cash flow and expenses and how they're going to be covered and what the risk is going forward.
Absolutely. Yeah. Good.
Yeah.
So let's kind of maybe talk about some of the self-funding assets that you may be thinking about. Hey, this is how I'm going to take care of my long-term care needs if they come up. Obviously, we talked about retirement assets. Maybe you've done a really good job of saving, and you're not going to use all your retirement assets for you and your spouse, and there's going to be money left over. So that's how I'm going to fund, a long-term care crisis that might come up. I have a home that's paid for. That might be an option for you. Or I have some other assets that are outside of my 401ks and IRAs. Maybe I owned a business and I have business assets still that, could be available to pay for that. Or maybe I have a rental home that I could use to help pay for any long-term care that I need or my spouse needs. Or you've got one of these life insurance policies that are old and don't have one of these new riders on it. So here's, maybe 6 different areas, and all of them could be a possibility, but some of them I'm going to point out might not be the right time to liquidate. So if we were sitting here in 2008 and we were having the real estate crisis that we had, well, it might not be a great time to sell your rental property because it's down, but you're in a long-term care need and you need to, raise some cash quickly. So that might not be the best option. Or you sold your business and you're, to your children, and, it's not a great time to go to the children and say, hey, I sold this business to you. I need all those funds that you were going to think about paying me over the next 10 years. Well, again, they may not be ready for that discussion. So all these could be self-funding options, and they, are all part of that is on the table, but we also have to be clear on, is it the right time? Will it line up correctly when you need, to pay for those extra bills that are coming in because one of you are in a nursing home or assisted living? So
I like the asterisk down at the bottom. The tax professional before taking action. That's some of these could have this huge tax problems tied to them if you that retirement investment account, if you took a huge distribution in 1 year, that drives up and your income, it drives up your income tax brackets, both at the state and the federal side. So there's a lot of consequences to just make sure you're, again, fully aware of, going in eyes wide open before you make these decisions.
Yeah, exactly. So if we were going to sit down and talk about, what makes up a strong long-term care plan, we're going to, ask a lot of questions, obviously, get to know you as an, age, the marital status, what's your health history, what's your family health history. Some people have some military, veterans have some options through that, not all of them, but that's something we talk about. Where you want to be, location, again, understand your assets, how liquid they are. Like Mike says, is there some tax ramifications to those assets? And what other retirement goals and financial planning are you planning? And then, do you have some legacy or estate plans, that you want to do with those funds? So it's going to be a very, 360-degree viewpoint of this plan. And we want to really understand that because, again, it's going to be unique for every situation. Depends on what's going on in their lives and what's going on. So
nice tie into the company name.
Yes, thank you.
I appreciate that. And right smack in the middle is military service. And a question that did come in, and I was holding off on it because I knew this slide was going to pop up here shortly, was a question that says, I am a Vietnam vet with VA benefits. First of all, thank you for your service.
Yeah.
And then the question is, does this qualify for long-term care?
And really the best answer I can say is maybe. I hate to say maybe, but because I've had a lot of veterans and some will be able to have long-term care needs taken by the VA administration. And I've had some veterans, and depends the level of, I don't really understand, I think it's how long you served, what level you served, and things like that. So I'm going to have to direct that person back to the Veteran Affairs, administration, and let them answer those questions. And it's a good conversation because it will be something, a homework assignment we will give this person if we end up talking to them and say, hey, one of your homework is to call, the Veterans Department and say, the what if question.
Yeah, I was thinking the same thing, and it's sometimes I've seen it where it falls maybe under like a disability type of payment that's being sent out to the veteran, and it, in theory that it should be covered by the VA, but in practicality it doesn't seem like that's always the case.
Yeah.
So unfortunately.
So again, some questions that you'll have to ask yourself and have that conversation around the kitchen table with your significant other, spouses, if I do go on care, who will provide it? Where do I want it? And how are we going to pay for it? So again, those are some of the questions that we're trying to help. And we, as your financial advisor, a conversation we can have with clients to kind of get those questions flushed out and understand and shared with us so we can build the best plan possible. And that kind of ties into, again, it's going to be customized. It's going to be unique. Again, is it at home or where do you want to be? Again, how much is this going to cost, and where do we find those assets to, put together a plan if it's going to take some costs to do that or some premiums to do that.
Mhm.
So again, to kind of wrap this up before we get to any final Q&A, it's really, we remember what we started with, the problem. We know it's confusing, we know it's unaddressed challenge, but it's really important for people's financial security to have a long-term care plan. So that is still very remaining. And again, our solution is to have that safe, secure peace of mind about your retirement plan. You really do need to have some action or approach to maybe potentially pay for this long-term care need that may come up in your future, both for you and your significant other or spouse. So that's really the solution that we're trying to drive here at 360 Financial. And then finally, when we wrap this up and we send out the link for the recording, we're going to give you some resources. This is one resource. It's not just the numbers, the nuts and bolts, but it's also, how do I answer some of these questions? How do I have, if I'm a child of a parent that's dealing with some maybe a potential long-term care need coming up, is there resources out there? And we have a handout, and we have some website that you can click on and really drill down and get some of those questions answered beyond the numbers, because it's really not just a numbers question. It's also finding the best care possible for the situation that either you're dealing with for yourself or you're dealing with for your family members. So those are things that we can help deliver and get you more education and more information about long-term care planning options. Any final questions? Okay.
I was just gonna say, what I like about this page, this one pager that's on the screen right now is it does give you other options to look at, and those are good topics of conversation with your advisor. We are wealth managers, and our job as stewards of that wealth is to have conversations around how do you grow it, how do you protect it, and what are different options. So I see things on this like the two on the right, the reverse mortgage option and the HELOC option, and that's leveraging your home value to maybe pay for some care. Well, there's pros and there's cons to those sort of strategies, just as well as there's pros and cons to insurance, and there's pros and cons to self-funding. So having all the information, not only for you, but for your kids, and show that you kind of went through this discussion, is really a powerful legacy tool when that time arrives. So I think it's a real benefit to at least get this one pager.
Yep. So we'll include that with the mailing that will go out once the webinar gets approved, that we can share it with everybody.
All right, so let me see here. Thank you. I've got a couple other questions that have come up. So one is, what is the cutoff age for long-term care insurance?
It depends by carrier. I helped a client that was in his upper 70s get a new policy. So yeah, if again, depends on health situations, resources, so, but I have to say, there's probably a solution for, pretty much anybody that's, maybe 75 and under, 80 and under. So again, we'll have to do some shopping and, get the right fit if that's, if it's an age thing.
Yeah, and that depends on what the solution is, right, to that conversation. So another kind of tied into it is another question that came in says, I understand each situation is different or unique. So that's absolutely correct.
Yeah.
But generally speaking, now what level of retirement funds or what minimum dollar level should one consider self-funding long-term care? And I think what they're looking for is like a number. Sometimes people will say, hey, Mike, how much do I need to retire? Well, you can retire today. This might not be the lifestyle you want,
Exactly.
going forward. So this one, I think I'm going to, unless you have a simple answer, which I don't think there is one,
No.
it's hard to say. It's really based on what their expenses are now,
Yeah.
and what their expectations are going forward.
Yeah. The only thing one story I'll quickly share, I think, is somebody that feels that, hey, I can self-fund pretty much any long-term care that I may have. The generation that, we're working with in that group is, I've seen this, they're very well off. They could bring in home health care, but the healthy spouse is taking care of the unhealthy spouse, and it's practically putting them into an unhealthy situation because they don't want to take money out of their retirement accounts because they want to leave it to the kids, or they think they're going to run out. So they're just, struggling to take care of the unhealthy spouse in their home versus paying for it. But if you had an insurance policy, just like if you had a car accident, instead of fixing your own car, you're just going to go down to the auto dealership, pay the $500 deductible, and get your car fixed. Well, I think if somebody had a pool of money sitting in an insurance policy that was just a phone call away, they would go ahead and call the insurance and get the help they need and pay for it out of that pool of assets, even though they have enough in their other assets. I just think I've seen this more than once, Mike, and it just, I try to get them to say, hey, you have enough to go ahead and get the care you need. And I'm very passionate about getting, because again, taking care of an 87-year-old when you're 87 yourself is not a great, solution. So that's my, yeah.
I know that, and a couple other questions. One's kind of housekeeping. Where's the summary of option page available? I think that was the last slide. I said it was a good one. If I understand correctly, Trony's going to send that page out to our participants.
Yep. Anybody that signed up for the webinar will get that. It does take a few days, Mike, to get us, get the webinar approved by our back office. So look out for that in a few days. So,
okay.
Yeah.
And then let's see here. So we've got that covered. Again, somebody's again asking the same person as far as retirement fund level, how much you need, and again, I just would say, I'm not even going to throw out a number.
No, I'm not gonna either. Yeah.
Everybody's situations is different. And
Yeah.
you know what, if you spend a few hours on what we call our life wealth planning process, you'll have an answer to what are the best options for you. So I would really just encourage going through the life wealth planning process with your advisor to determine, is it 2 million you need, or 3 or 4 or $1 million? It's just everybody is different.
Everybody's different. Yeah.
I will give an interesting thing that happened once to me a number of years ago. I would guess it was about 10 at this point, where a client said, I think I want some long-term care insurance. And I said to her, well, your net worth is probably 20 to 30 million dollars. You don't really probably need it. There's enough assets to self-fund it. And this is the only time I've ever heard this in the 30 years of being in the business. And the response was from the client was, I don't want my kids to be worried about making health care choices for me based on their inheritance.
Yep. Okay.
In other words, and it's she was saying that she was worried that the kids wouldn't give her the best care because it would eat into their inheritance, which is sad for lots of reasons. But it shows how this situation is so unique. You don't know what people's concerns and worries are.
Yeah. Yeah, I think it ties into my story about, hey, you may have enough to self-fund it, but you just want to hold on to those dollars, either for the children or you think it's going to be needed for the healthy spouse. So I'm just not going to go and get the care I could obviously afford.
Yeah, absolutely. So let me see if anything else has popped up. Questions keep coming in. So if it's okay with you, I'll keep bringing them in.
Right. And we got a few more minutes before we move on to our next section too. So.
Okay, so let's see here. There was a question here. Do you know, and I'm not sure we know the answer to this offhand, maybe you do, Brian. Do you know how long-term care costs are determined in Minnesota? In North Dakota, the Department of Health sets the cost depending on the needs of the person needing care. So that I'm assuming is talking about medical assistance and how those costs are determined by the state. I don't actually have a good handle on that number. Do you?
I know I think if that person's talking about what the reimbursement will be for a facility when you are on medical assistance, yeah, that is determined by the state of Minnesota, what that facility will receive from the state of Minnesota for the services that were provided for that person. So yeah, that's set. Just, kind of like Medicare, doctors get paid on a Medicare, table of costs. So I think that's, if that was the question, Mike, I guess.
I think so. Maybe that one, we can make a note of it and get back for some clarity, and then we could answer that, just because I want to be aware of time for people who have jumped into this call and expect it to end fairly soon here. But there's one other one that is, what is one able to spend out of their trust? And then the question was, can that go towards home care? And
yeah, if it's a trust that is a irrevocable trust, that means it's liquid, it's controlled by the person. Yeah, then you can pull money out of that trust. Again, every trust is written a little bit differently, but what I've seen in the past, if it's for your health and welfare, most trusts are written that it can be used for health and welfare out of that.
Yeah, that's what I've seen as well. So, Trony, why don't we have you jump back in? I've answered, I think, or we've answered, Brian's answered mostly at the questions that have popped up. Very active conversations. And just again, reaffirms it's a good time to have these conversations with your family, with your advisor. Make sure that you're going in the direction that's comfortable to you.
Yes. So thank you, Brian and Mike and the attendees. This is great. A lot of wonderful questions. So again, we will be sharing the recorded webinar. We'll be sending out that summary sheet, and actually I will be sending it out when the webinar is complete, and then we'll send out the links with the recording in a few days. So we'll get that out to you as quick as possible. If you're interested in a complimentary planning consultation, please feel free to reach out. I'll also note that is it for the Q&A session. So Brian, if you don't mind paging through the formalities here, that would be wonderful. And then if you're interested in learning more about 360 Financial, we have a little presentation to share with you on kind of how we work and what we do. And with that, I will pass back to Mike.
Well, thanks everybody, and thanks for joining us for this very important conversation. This next little few minutes is really just for the people who don't know us, or if you want a refresher on how we work, that's fine. We can talk about, but I think for the people who've joined this who have not worked with us, it's always helpful to know, okay, what does 360 actually do? And so, Brian, if you could jump to the next slide, since you're controlling this for me, is I started up the firm in '95, and we started up the firm based on the thought that there had to be a better way to work with clients. I came out of the big box investment firm environment. Everybody was treated the same. You got a number when you walked in the door, so to speak. There was a product for you to buy. I didn't want to be part of that environment. I actually was a very unique environment where they said that, what else is out there, and left the big box environment. And that doesn't happen very often, especially back in 1995, to set up a financial planning firm that was fee-based, that was stewardship-based, that had a core purpose to what we have now. Now, I'll be honest, in 95, I didn't have this core purpose written down, but we do now. And our purpose as a firm is to enrich our clients' lives. We help them by navigating and leading them through impactful financial events. And we have a set of core values that we live by at the firm: confidence, going above and beyond, positivity, problem solving, community impact, and integrity. And our clients that have stayed around for this part of the presentation, hopefully have seen that. They've seen where we live these core values, either when you call up and you get a pleasant person who answers you, answers your call on the phone, or if you're involved with the Lake Minnetonka Triathlon, because we have that as our 501c3, and that's our biggest community impact and fundraiser that we help manage and run. So, it's kind of our why. Well, really what we're trying to solve are the client's whys. And so when we go to the next slide, when we look at focusing on what matters to you, that's what everything is built about. Okay, and so we're trying to figure out your why. And we use an acronym called FORM: family, occupation, recreation, and money. Okay, so let's set goals around all 4 aspects of what's important to you, what matters the most, and then we can start creating a plan around those aspects and then what we can control. Now, unfortunately, we had a bear market last year. We could not control how the stock market was going to act. We know tax law changes are going to occur. What we can control is how do we react to those events, to those changes, and have a consistent philosophy, have a consistent planning cadence, and have a consistent process. And if we can control those with you in a collaborative manner, you being a client, then I think we have a really good chance for some really positive outcomes. And all of these outcomes are built in this strategy called the Life Wealth Plan. We're just taking your life goals, your wealth goals, we're putting them together so that we know we have something special here that will drive kind of this legacy planning, that will drive the results that you want for yourself and for your family. And as you go to the next slide, we're really focusing on these impactful events. And we talked a little bit today about legacy. We talked about, the issue around long-term care, but there's all kinds of different issues that need to be addressed. And so our clients come in at least once a year, or Zoom calls now have become obviously more prevalent. But every quarter we have a conversation around a topic that has to do with their impactful financial events. And that's what makes up the spoke of these different areas. So this program today, could actually fall into a number of these different bubbles. But let's put it into the legacy part of it, because you're protecting assets, but it could also affect your tax planning. It could affect your retirement planning. It can protect your family security, of course, and how do we manage your assets and the investment piece. So these become a wheel that needs to constantly be addressed and constantly monitored to make sure that we're going in the right direction with our clients and with you if you are a client. So when you go on to the next page, we talk a little bit about our investment piece, because people always ask, how do you invest our funds? And everybody's a little bit different. The asset allocation is based on a risk tolerance. We use a pretty sophisticated software to try to do an assessment. And we generate an investment policy statement for our clients. And really what we look at is this approach that we believe there's a foundation piece to an investment strategy, and then there's a leadership piece to the investment strategy. And the foundation is made up of good quality bonds, if that's appropriate, based on the risk, or bond funds. It's based on big dividend paying stocks of companies that increase their dividends. Just, best way to stay ahead of inflation, which has now become a buzzword, which, a year ago we forgot all about, was typically through dividends, not through bonds. So let's have a nice base. And then on top of that, let's see if there's opportunities in the market that we can take advantage of, whether that's semiconductor stocks, or maybe and again, we're typically using exchange traded funds, low cost baskets of stocks or bonds to drive this asset allocation. And then we monitor it. It's never set it and forget it. It is monitor it And every other week, our investment committee gets together. We have a meeting after the markets close on Tuesday. We just had one yesterday. We send out the minutes to those meetings to our clients so they know what our thought process is. And we make investment decisions from those meetings, which currently has 6 people on board with literally over 200 years of investment experience collectively. So it's a pretty good group of people who have seen lots of things come and go through the years and have experience on how to react to those events coming and going. So our process really is simple. If you're not a client with us, if you are, you've gone through this, but we're more than happy to go through it more with you if you need that. But we start at the very beginning, on the left-hand side, is there a good fit? Does our service match up to what you need? Sometimes it does, sometimes it doesn't, and we have certain things that we just don't do. And we have certain things that we believe really are part of our core values. So we just kind of make sure that we have an alignment there. If we do, then we move into this go phase or get organized phase, where we start pulling together all of the data and information and start asking you some really deep questions about how money was treated when you were a kid, and what do you want your legacy to be, and then we start taking that information and we start building your plan, and we call it again the life wealth plan is what comes out of this process, and like everything in this world, constantly changing. We need to constantly be reviewing and realigning not only your strategies but the plan itself. So this looks simple because it's only 4 little steps, but it is an ongoing communication, collaboration between us and the client to make sure that we're always addressing what the specific needs and those changes are as we go through them.
Yep.
And I think the last is the other thing I was just going to bring up is, out of all of this, when you go through the life wealth plan, we get done with this. Sorry, I got a phone call rang out of my computer. When we get done with this process, you get the what if binder. We call it the life wealth organizer. The life wealth binder is really just that. It's a physical binder if you want it, or we can do it electronic, either way. But it's there for your family, where you can pull the binder off the shelf. You can open it up and say, okay, here's my investment policy statement. Here are my legacy plans. Here's my tax returns for the last year. Here are my wills. Here are my trusts. And it's in one spot to really drive the planning process kind of to that generational basis or generational need. And I think it's a great tool. And most of our clients, I think, agree with me. But it's the end result of this is that organizer to keep this all moving forward for the client. So with that, since we didn't have a little slide showing the organizer, I wanted to bring that up. If you need a personalized life wealth plan, if you need a conversation around risk and insurance and long-term care needs or other risk, we're here for you. Whether you're a client, we're here for you because we contact you on a regular basis. We can have these conversations, or we're here for you if you're not a client and you just want to learn more about how this process might benefit you and your family. We're open to conversations. We never charge for a conversation. We can get into our fee structure and how we do get paid as we go through the next steps with you. I encourage you and welcome you to join us for a conversation. I think that is it.
That is it.
That is it. So thank you again, Brian, for fielding the questions. Thank you, Mike, for teeing them up and enlightening everybody. I think this was a very informative webinar. And thank you, attendees, for your participation. And yes, please reach out if you need anything from us. We're here to help. Thank you.
Thank you, everybody.
Thank you.
Bye.
Bye-bye.